Good morning. It's Thursday, the 5th of June, and this is Govindraj Ethiraj broadcasting and streaming weekdays from Mumbai, India's financial capital. Before we start, we may not have an edition tomorrow as I'm on the road, but we'll be back next week. The top stories and themes. The stock markets break out of a losing streak. The rupee is amongst the worst performing Asian currencies in recent weeks. India's census exercise is now slotted 7 years behind schedule. Rare earth supply fears spread around the world. Automotive companies gear for plant shutdowns, including in India. Did you know who actually makes almost 90% of the famous Dubai viral chocolate?
This is a call report with Govindraj Ethiraj.
The markets recover. The stock market snapped a 3-day losing streak and closed in positive territory, picking up on rallies in global markets, many of which are nearing or touching all-time highs again. US President Donald Trump set Wednesday or yesterday as the deadline for when trading partners would submit proposals for trade deals to avoid his Liberation Day tariffs from taking effect in about 5 weeks. He also said in a late-night Tuesday night social media post that Chinese leader Xi Jinping was very tough to make a deal with, which obviously raises the question of whether there is any meeting point between the two on the horizon beyond the present truce and what that means for everyone else. While Indian markets are somewhat directionless, the global market cues are still on the positive side. Actually, global equities hit a record high for the first time since February as signs of a resilient US economy overshadowed uncertainty around trade negotiations. The MSCI All-Country World Index rose as much as 0.3% to 888 points, surpassing the previous high of 887.7 hit in February, according to Bloomberg. Elsewhere, again on Wednesday, Germany's benchmark index hit a record high after an approval of a 46 billion euro corporate tax relief package aimed at kickstarting growth in the region's largest economy, according to reports. Higher US tariffs on steel and aluminum also took effect on Wednesday, applying to all trading partners except Britain, the only country to have struck a preliminary trade agreement. Back on the Dalal Street, Indian markets are also eagerly anticipating and to some extent assuming an interest rate cut on Friday. The Sensex was up 260 points to close at 80,998 and the Nifty 50 was up 77 points to close at 24,620. Amongst the broader markets, the Nifty Mid-Cap 100 and the Nifty Small-Cap 100 were also up at 0.7 and 0.79%, or 0.8 almost. The rupee has not been having a good time. It declined for the 6th time in 7 sessions on Wednesday, falling or rather going past 86 to the US dollar as traders unwound bullish positions. The rupee closed slightly lower at 85 rupees 90 paise, according to Reuters. The currency has now declined about 1.5% from a high of 84 rupees 78 paise touched last Monday, making it now one of the worst performing Asian currencies in this period, according to Reuters. Meanwhile, some other developments affecting stocks here. The Wall Street Journal reported day before that Gautam Adani is facing a probe into whether his companies are buying Iranian petrochemical products. US prosecutors are investigating whether Adani companies imported Iranian liquefied petroleum gas or LPG into India through its Mundra port. A company spokesperson said in a statement reported in the Wall Street Journal that Adani categorically denies any deliberate engagement in sanctions evasion or trade involving Iranian origin LPG, nor, they said, are they aware of any investigation by US authorities on this subject. Elsewhere, in a sign that car maker Hyundai does not see much of a future in electric two vehicles or in one electric vehicle company, it has sold its entire stake in Ola Electric, while fellow South Korean car maker Kia has also reduced its holding in that company. The combined share sale brought in about $80 million or about 689 crore rupees, according to Reuters. Ola Electric shares are below water, which is quoting at about 50 rupees 70 paise, which is obviously much lower compared to the IPO price of 76 rupees per share. IPOs in general are sucking up capital at a very high intensity in recent months, a phenomenon usually seen as markets peak and institutional investors rush for the exit. Meanwhile, data is the oil that financial markets also look forward to. This includes demographic and other data which will help understand aspects of the economy and economic mobility. The government said on Wednesday that it will conduct the population census beginning from March 1st, 2027. That's almost 2 years away. Caste census will also be a part of this process, according to the Ministry of Home Affairs. The census was initially scheduled for April 2020 and postponed at that time due to COVID-19. The government said, however, that the Union Territory of Ladakh and other snowbound areas of the Union Territory of Jammu and Kashmir and states of Himachal Pradesh and Uttarakhand will start earlier. That's October 2026, which is also next year. Rare earth fears grip the world. We spoke of the rare earth challenge that Indian automakers are facing yesterday because of a slowdown, if not lockdown, of China's exports. Reuters is now reporting that the alarm over China's stranglehold on critical minerals grew on Tuesday as global automakers joined their US counterparts to complain that restrictions by China on exports of rare earth alloys, mixtures, and magnets could cause production delays and outages if there was no quick solution. German automakers said on Wednesday that China's export restrictions are already threatening to shut down production. In April, China suspended exports of a wide range of critical minerals and magnets, which has log-jammed the supply chains to automakers, aerospace manufacturers, semiconductor companies, and military contractors around the world, according to Reuters, which added that shipments of those magnets, essential for assembling everything from cars and drones to robots and missiles, have been halted at many Chinese ports, while license applications make their way through the Chinese regulatory system. Companies and governments are scrambling to find alternative options, but obviously there is no clear alternative option. China controls more than 90% of these flows. Reuters also said that diplomats, automakers, and executives from India, Japan, and Europe were urgently seeking meetings with Chinese officials to push for faster approval of rare earth magnet exports, and something that we reported yesterday as well. Bajaj Auto, for example, has warned that any further delays in securing the supply of rare earth magnets from China could seriously impact electric vehicle production. The Alliance for Automotive Innovation wrote in a letter to Donald Trump last month and reported in media that without reliable access to these elements and magnets, automotive suppliers will be unable to produce critical automotive components, including automatic transmissions, throttle bodies, alternators, various motors, sensors, seatbelts, speakers, lights, motors, power steering, and cameras. Nuclear energy moves. Constellation Energy has agreed to sell power from its Illinois nuclear plant in the United States to Meta Platforms as AI sends power demand soaring, according to a Bloomberg report. The parent company of Facebook, Instagram, and WhatsApp signed a 20-year contract to buy 1,121 megawatts from the Clinton plant starting in mid-2027 when a state subsidy expires, according to a statement put out on Tuesday. Constellation is the biggest nuclear operator in the United States. And here's a message from a sponsor. Want smarter investing at your fingertips? With InvestingPro, get real-time market data, custom alerts, and global financial insights all in one place. Join 46 million users already making sharper decisions. Download InvestingPro today. More details in the link below. The future for small and medium enterprises. Some of the most silent sufferers in the tariff wars currently being waged world over and affecting India are small and medium enterprises. The near future looks grim, if not uncertain, for several of these small enterprises, including in areas like apparel and gems and jewelry, particularly the export-oriented sectors. But so far, the sector had been stabilizing. Overall, balance level delinquencies in the micro, small, and medium enterprises segment fell to a 5-year low of 1.79% as of March 2025. On the other hand, commercial credit portfolio grew 13% to about 35 trillion rupees during the period, according to TransUnion CIBIL and SIDBI's MSME Pulse report. The report said that this improvement has been driven by the borrower segment with 50 lakh rupees to 50 crore rupees exposure, while the segment with less than 50 lakh rupees exposure witnessed a slight deterioration in March 2025 compared to a year ago month. So in this sample, it does appear that smaller enterprises have been more hit. May not be linked to the recent tariff problem, but the overall economic slowdown. Amongst lenders, private banks hold the best performing portfolio, says the report, with just 1.2% delinquency, while public sector banks stand at about 2.1%. The report also said that commercial loan demand in the MSME segment grew about 11% year on year, though commercial credit supply by value grew only 3%, with a 11% decline in the last quarter, possibly because of higher credit concerns amongst lenders due to increased external headwinds, which goes back to the state of the economy. So, what are the trends in MSME lending for both cash flows and loans, looking at it from a large intermediary's point of view? I spoke with Rohit Arora, CEO of Biz2X, a platform for small businesses with a sister platform in the United States. And I asked him how he was seeing trends in SME lending post the recent tariff tensions and his takeaways for Indian SMEs and the way forward.
So we are seeing three broad takeaways. We have a pretty large lending business in US also. So the US is our home market, and India, we do a lot of this, our platform business where a lot of NBFCs and some banks in India use our platform for SME lending. So we have a lot of data insights. I think there are three trends happening. One, obviously, is that a lot of the importers in US have been looking to diversify their supply chains away from China, which should have helped India more, but it hasn't helped Vietnam, and some of the other Southeast Asian countries have gained more market share out of it.
And if you were to look at the Indian SME universe to whom you lend or you facilitate lending, what are the key trends that you're seeing, particularly in the last year or so or post-COVID phase?
There are three distinct trends there. Obviously, we have seen that, the demand for credit had increased quite significantly just after COVID. Last year and a half has been challenging. There has been a overall slowdown in the industry, including capital goods, including FMCG, including some of the other sectors. We see demand has now stabilized. It's not going down anymore, but still it's challenging. Lending side, actually, it's interesting because, NBFCs are playing a bigger role. We are seeing even more SME focused lending happening from SMEs, and even in this very tough funding environment, still some more funding coming into NBFCs predominantly for SME and less in consumer, because after the RBI clampdown last year on the personal loans and consumer loans, that activity has now shifted to SME. So I think from that angle, it's a good angle. I think the challenge still is access to credit in India is pretty expensive and not very deep. So because the securitization markets are not that deep, the rating mechanism is not really there for SME loan portfolios, unlike US, where it started happening 3-4 years back, and now a lot of insurance money and a lot of pension fund money starting to pump in directly into those asset classes, which obviously in India, we don't have the rating mechanism for SME loan portfolios. So you can rate the NBFCs, for the debt they raise or the debt they offer to raise, but not the loan portfolios itself per se.
Right. And if you were to look at, let's say, sectors, or if I were to ask you for examples about where you're seeing shifts in the Indian lending portfolio, what stands out in terms of either new industries that have come in or faded out or any other trends that you're seeing?
So I think in terms of the trends, what we are seeing is that obviously, as I said, the export-led SMEs historically have done better in the country, but that might change now with all the tariff stuff coming in. So the other thing is that, I am also looking at the fact that, with SMEs themselves, the good news there is they are trying to get more digital and more efficient. Actually, that wasn't the case earlier. SMEs were very much, in India, were caught in a time wrap. The good news there is that they are getting out of it at a pretty good pace right now. That's happening. I think the third thing is going to be that with the realignment of the supply chains, eventually it all depends on how China and US trade pact comes along. But whenever it comes along and everything, there's a very strong feeling in US now that, companies there have to diversify their supply chains and they cannot be totally dependent on China. Now, that's a very big opportunity for India. I think the challenge for India is that, how do it gets its relation normalized with not only US, but China. Because if we are able to do that, then a lot of these Chinese manufacturers can also move into India, actually. But I think the political situation is not that conducive for that today. But I think the things to learn from Chinese is that a lot of Chinese exports have been powered by their SMEs themselves and their ability to create the nurturing ecosystem environment and infrastructure is unparalleled in the world. So there is an opportunity to bring that into India now. I think the key question is the economics and the politics of it, that how both things will pan.
If you were to illustrate that, so the government in India also has been saying and has for a long time that we want to help SMEs, we want to get them easier access to funds, whether it happens or not. And there's a lot of effort. So when you quote the China example, what is the one or two things you feel that we could do in India which would create some kind of level playing field for Indian SMEs as well?
I think there are 2 or 3 things. What Chinese SMEs did really well in last 30 years is that they were very focused vertically, in if they were producing subcomponents or something like that. The second thing they did really well was that, the government really helped them to create the right infrastructure and the cost of money was very low. So there was a time in China where as an SME, you could borrow at like 3-4%, actually. And that really helped them a lot. And then players like Alibaba and Ant Financial, really helped them to grow the business. So which was massive. I think the third thing is that, how do you improve your logistics and your overall ease of doing business? Chinese did that really well over last 30, 40 years. They made it so easy for Western companies to ensure that they could get the right sourcing done, from China. And they made it very seamless and experience. And that has to improve because more and more, I'll give you one example, there's a whole rage around Dubai chocolates, these days. So you go anywhere, you say Dubai chocolate. But
Dubai viral chocolates.
yeah, but now the key thing is that, and that has become a huge rage in US, but 90% of those Dubai chocolates are actually manufactured and are being, shipped from Turkey because UAE doesn't manufacture. And, already in the last 7-8 months, the import of Dubai chocolates from Turkey started at zero is like $3 billion a year already. Already. So imagine that why can't a country like India, like they are celebrating today International Milk Day or something like that. And these are all milk chocolates. And these are high margin, very visible products, and the high growth products. So if you go from 0 to 3 billion in 7-8 months, you could be an 8 to 10 billion. That's a massive addition, not to only your growth, but also profitability. And in Turkey also, these are being manufactured by like small and mid-sized enterprises, not by big companies.
Right. And that's an interesting example. So, when you look at Indian SMEs, and, I think the Dubai example is interesting because it came out of an Instagram post, a creator who posted on Instagram, and then someone else reposted it who was already well known, and then it went completely out of the park. I guess there the linkage is between, let's say, the creativity and the commerce part. When you look at Indian SMEs and assuming, let's say, they're doing well on the production front, so the constraints that you speak of are well known. What is it that you feel Indian SMEs could focus on? Maybe learning from either the Dubai chocolate example or some other example.
Yeah. So Indian SMEs, like I was meeting a guy the other day who does a lot of the jewelry export and all that. So my first question was that, have you thought about setting up a D2C brand, out there in US? I said, why? Like I said, how do you sell it? He says, trade shows, we go there all the time. We book orders, we come back, we give it to the distributors out there and all that. So I said, why don't you set up a company out there also? And while you're doing this, why don't you, start doing direct to consumer and also use Instagram or TikTok? Dubai chocolate was all built on Instagram and TikTok, literally nothing else. Because in this day and age, the good thing is, and the other thing is how Temu and Shein have grown so much that even today in US, in spite of all the tariff bars, any shipment which is less than $800 has zero tariff. Now, there are things like steel pipes and other things that obviously there's no D2C brand, but a lot of Indian SMEs don't focus in that. They are focusing in things like jewelry, gems, apparel and all that kind of stuff. There's a massive opportunity to go on social media platforms and then combine it with D2C strategy. And if you keep your each shipment below $800, then you can beat the tariff. Yes, the freight cost will be higher in this case, but once you equalize it with the tariff impact, it's a win-win. And secondly, going directly to the consumer, you're also increasing your margins, which then you can use to reinvest in your product, marketing, logistics, and everything else.
Right. Last question. So, as you look ahead in the Indian market again, are there any specific new products that you're thinking of or product categories that you're likely to get into?
Yeah, so one of the things we are looking at as more like supply chain financing. The second we are looking at is more of a factoring for exports, because today what happens with SMEs is that when they're going to banks to try to get money, it's almost impossible for an exporter. They have to hypothecate all their assets and everything. So now RBI is starting to issue RBI factoring licenses for some of the NBFCs, and they're partnering with us because we have also created business in Middle East, which same financing business, but then that can act like almost like a transshipment point for a lot of these goods exports, into Americas. So the idea is that as RBI is starting to do these factoring licenses now, because they are also realizing that if you're just dependent on banks for all the export-led financing, that won't happen. It might be more cost effective, but from a paperwork, from a overall, regulatory aspect, it just takes forever. So that's the other product. Secondly, we're also looking that if we can do something from India for these SME exporters to get certified and ensure more quality control and QC and QA for them to go and do better and have better opportunities, not just in Americas, but then also in Middle East and some of the other economies which are doing pretty well, and then just take it from there.
Right. Rohit, thank you so much for joining me.
Thank you.
Betting ads are trying to fool you. As our digital footprint and consumption of media and content grows, so do digital-only efforts to manipulate internet users into parting with their savings, and that includes you and me. The Advertising Standards Council of India, or ASCI, has released its annual complaints report for the year 24-25, which found that offshore betting has emerged as the most violative sector, contributing to 53% of cases. This was followed by realty, which is another big surprise, at about 24.9 or about 25%, personal care 5.7%, healthcare 5.2%, and food and beverage 4.7%. So there are some distinctions here. The ASCI usually looks at advertisements which make tall or false claims. But in the case of betting, these are ads that mostly should not be there or are violating other existing laws. Influencer violations, says the ASCI report, contributed to 14% of the ads processed. ASCI looked at about 9,599 complaints and scrutinized 7,199 advertisements. Some 98% of the advertisements scrutinized required some form of modification. To return to the banned categories, ASCI says 3,347 of those ads belong to categories that are prohibited from being advertised at all by the law. And these include about 3,000 ads of offshore illegal betting platforms, including 318 ads pertaining to influencers who promoted such platforms, 233 ads that potentially violated the Drugs and Magic Remedies Act, 21 that promoted alcohol brands, and 12 promoted by unauthorized forex trading apps, which have been banned by the Reserve Bank of India. ASCI said it looked at about 1,000 influencer ads, of which 98% required modification. Of all of this, which is the ads processed, 89% came from ASCI's proactive work, it says, and the remaining 11% were based on complaints. ASCI's recommendations often lead to action, with advertisers usually changing their advertisements or modifying them, as the case may be, particularly in mainstream media or involving mainstream brands. That obviously is not the case for offshore betting ads and so on. I reached out to Manisha Kapoor, CEO of the ASCI, and I began by asking her for highlights from their work in the last year and also to walk us through why areas like real estate were showing such high levels of deceptive advertising.
So I think one is, if you just see over the last 2 to 3 years, we have seen newer categories kind of emerge as top violations. There was a time where education, healthcare, etc., used to be the top 2 or 3 categories, and they have now been replaced by certain other categories. So, offshore betting as a specific example of what has emerged at the top. Reality is another thing that we have been scrutinizing over the last year. Therefore, we see newer categories, newer formats kind of making it to the top of the table. So that's certainly one change that we have seen that's happened over the last 18 to 24 months. And I think the other thing is just that digital is becoming a bigger and bigger part of both what we are monitoring and where we are therefore also finding violations. Digital used to be about, even 4 years back, around 35% of our work, and today it's over 90%. So clearly that's an area which is also focused for us, but we are also having to come up with ways in which we monitor an unlimited and infinite media.
So, which would also suggest that gullibility levels are higher for digital consumers compared to television and print.
I think because television and print have historically had grown up in that sense or evolved in a regulatory environment, I think the systems and processes are perhaps more established. I would say that in digital, because it's such an open kind of media, you have a number of new advertisers, very small advertisers, companies' own websites and channels which are there. So, it's just multiplying and exploding in terms of what could be made available there. So it is consumer vulnerability, but also just, I think, the nature of the media where you see a lot of violations coming in.
Right, and I'll come to offshore betting in a second, but reality is almost 25%. Now, the reason these ads come to you is because they're obviously proposing or professing something which is not true or not backed up. So, what was it in the case of realty, and why is it so high?
So one of the things that we've started doing is to really look at certain focus and priority sectors, because as I mentioned, it's difficult to monitor every single thing on digital. So even as someone who is monitoring the environment, we need to say, okay, these are 2 or 3 areas of potentially greater consumer harm that we must focus and prioritize. Last year, we did a tie-up with MahaRERA, the Maharashtra regulator for realty. So they asked us also to look at some of the violations in the sector, and therefore our scrutiny also was high in the realty sector. The Maharera itself had a few regulations in terms of QR codes being available on their ads that consumers could immediately see the details of the project they might be investing in. And we found that many of them were not carrying those or that information that consumers needed to make an informed choice. Therefore, in coordination with Maharera, we undertook a project, and which is why you also see a lot of scrutiny that we had on realty last year. But as I said, I think the overall approach is to look at sectors which we feel will have a higher consumer impact in terms of harm.
Right. But in reality, your partnership was with Maharashtra, but the numbers are national, right? I mean, when you say 25% of your total sample.
Yeah, the numbers are national, but most of the realty work has come from builders who operate in Maharashtra. But of course, if we were to receive a complaint from any part of India on realty, or if we were to come across in our own monitoring an ad that was placed in another part of the country, we would pick that up, of course. But in this particular instance, the majority is likely to be from Maharashtra.
And you're saying in most cases, at least in the Maharashtra context, people were not, the builders or developers were not giving links to the regulatory site for their project and so on, right? Is that the main complaint?
Yes, so that was the complaint that Maharera wanted us to kind of focus on. But of course, when we saw an ad, we would also look at it for other kind of violations. So we looked at it across a number of possible violations on the ad. But yes, Maharera, because it was a new provision that they had introduced, was very interested in knowing the compliance regarding the same.
Right. Now, let me come to offshore betting. So, where does this come under? Because offshore betting in principle is not legal, but you're looking at what is the claim here versus whether it's backed up or not.
So there are a couple of things, Govind. One is that categories like offshore betting are in violation of most laws of India. So, betting laws are state laws, but most states in India have banned betting. And therefore, the focus on ads that are, in a sense, prima facie not allowed at all to be broadcast in India or to be shown to the Indian public. Many of these operators are offshore. They have no presence in India. And therefore, as a self regulator, it is difficult for us to identify where they operate out of or what jurisdictional action can be taken. So, what we do in these cases is that when we identify these ads, we escalate them to the Ministry of Information and Broadcasting, who, with the help of METI, then block these websites or get these websites or links taken down. So, that is the action that is really needed because, as I said, I mean, these are not legally permissible ads in India.
So, the issue here is that those ads are visible in India and are being obviously consumed, not the fact that they're making a claim that is contestable or false and so on.
So, as of now, we are escalating them for their mere presence because the presence itself is not allowed. Should there be a regulatory framework that permits such ads, then we can look at the content of that ad and see whether that adheres to certain regulations, etc. But when the advertisement is not permitted in the first place, then that itself needs to be first addressed.
Okay, so healthcare, personal care, and food and beverage are about 15%. So within that 15%, are there standout categories vis-a-vis previous years, or is it similar types of violations?
So the violations are similar, but what we see, as a constant increase is personal care getting impacted a lot by influencers, and influencer violations are quite high in that category because personal care, I think, relies a lot on influencer advertising and influencer marketing. We see that many brands come up as violators, not because of advertisements they may have released themselves, but because of advertisements that are spoken of by their influencers. Now, this obviously points to the fact that controls seem to be not adequate, that brands need to be able to develop systems when influencers are speaking about their brands so that they are not in violation. And many of them are, in violation of the disclosure norms, which is just not declaring to consumers that these are ads in the first place. And then, of course, what content is being spoken. And there we see healthcare, for example, coming up a little bit more, where the content of what is being said needs to be more monitored and needs to be, more careful in terms of a healthcare claim that is being made to the public. Our guidelines also require people making specific healthcare claims to be appropriately qualified to be making those kind of claims. And those are the kind of violations we see on the influencer front that are also pushing these categories up the chart.
Any example that illustrates this in terms of kind of healthcare claim or product claim?
So, I mean, I won't name the company, but very recently we had an example where an influencer was talking about a skincare cream and talking about certain ingredients and certain benefits, which as an ordinary consumer, you would not know. You talk of certain acids and certain ways in which they act upon your skin. Now, that as an ordinary consumer, I would not know. But, if an influencer is making those kind of claims saying that, these ingredients work in this manner, or, they're able to kind of take care of certain issues in your skin, then on what basis are you saying that? That needs to be clear. So do you understand the issue, or are you just saying that? And for healthcare claims, we need the influencer to understand the issue independently, not just because that is being said in the advertisement.
Right, Manisha, thank you so much for joining me.
Thank you, Govind. Always a pleasure.
That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in. And thank you once again for listening.